This week on Wealth Track, leading global value manager Chuck de Lardemelle says it's time to hedge stock portfolios and to do it in something other than cash. He is next on Consuelo Mack Wealth Track.
Funding provided by Morgan Le Fay Dreams Foundation, Clearbridge Investments, a Legg Mason company, Miller Value Funds, Royce & Associates, Matthews Asia, First Eagle Investment Management, Strategas Asset Management, and Eaton Vance.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. We watch big financial trends for you on Wealth Track, which affect the investment climate and obviously your portfolio. One was analyzed recently in a second quarter quarterly letter to clients from Ben Inker, the head of asset allocation at GMO. Inker, a past Wealth Track guest, has worked for years alongside noted market strategist Jeremy Grantham. The letter was titled Bigger's Been Better. In this case, bigger refers to the 50 largest U.S. companies by stock market value, called megacaps. The better refers to their record-making earnings and stock performance. As Inker wrote, U.S. stocks have profoundly outperformed stocks in the rest of the world, whether other developed markets or emerging markets. And the largest driver of the outperformance has been the massive superiority of earnings growth in the U.S. relative to anywhere else. And the improvement in profitability has occurred only in the largest companies. The top 50 mega-cap companies, to be exact. The tech names that you all know: Microsoft, Apple, Amazon, Alphabet, the parent company of Google, Facebook, and the more traditional business powerhouses: Berkshire Hathaway, Visa, JP Morgan Chase, Johnson & Johnson, Walmart, etc. GMO calculated that their profit value added, meaning their gross profit, that's revenues less the cost of goods sold, has increased by 62%, whereas the profitability of the next 450 companies improved by 37%, and the next 2,500 only 5%. Now, the other big issue is their stock market dominance. For the first time in history, assets in passive equity funds and ETFs based in the U.S. have surpassed assets in actively managed mutual funds. It happened this summer. These mega stocks dominate index funds. How they go, so goes the major market indices. The logical question is, how risky does their clout make the U.S. market? Well, this week's guest is known for assiduously avoiding market risk. He is global value manager Charles Chuck de Lardemelle, a founding partner of International Value Advisors, known as IVA, which he and his partner launched in the depths of the financial crisis in 2008. De Lardemelle is co-portfolio manager of their two mutual funds, IVA Worldwide and IVA International. Although both funds lag their benchmarks in bull markets, they protect in declines and have thus earned Morningstar's silver medalist analyst rating for their cautious, patient strategy, making them a valid long-term choice for wary investors. IVA describes its strategy as winning by not losing and looking to assess risk and try to avoid it wherever possible. I asked de Lardemelle where he is seeing risk in the world that he is avoiding.
Well, I think usually a risk is associated with too much credit growth, and there are a number of areas where we see a lot of credit growth. One is corporate America, especially in the high yield bond market, driven by buybacks and so on and so forth, and that usually leads to issues down the road. There has been too much credit growth in China for a number of years now, and we are not sure when that issue might come to the fore, but eventually it will. And the third one is more difficult to assess, but I think in Europe you still have issues with banks, and especially the idea that government bonds are risk-free, which we think is a lie in Europe, because Italy or Spain or France cannot print euros. And so we think there is a risk there that is substantial, because it's a risk that would bankrupt the banking system in Europe. And that's what moves a recession into a depression.
Would you ever get involved in a company or a country that does have a fair amount of debt to
Sometimes
GDP
we do.
or in their balance sheet? Or
look, value investing starts with price.
Right.
And sometimes the price is discounted enough of the risk that you're willing to get involved. You have to think when you invest internationally as well, you have to think about the currency. And sometimes the crisis ends up with currencies devaluing substantially, but you may have companies that are listed in a country that do business in a different country. So for instance, we own Antofagasta, which is a copper miner that's listed in the UK. There's no Brexit risk there. You know, Antofagasta is copper, it's a US driven business. So that's an example where, you know, you have a market that is at risk with Brexit, but the security itself, not.
Is fine.
Right.
Your sovereign debt exposure is zilch, right in the worldwide fund.
And our cash is commercial paper. It's not sovereign debt.
Oh, so it's not treasuries. You're
No.
not.
No.
Oh,
we pick our own commercial paper.
Oh.
So we get a bit more than treasury bills.
Well, how do you feel about the creditworthiness of the United States government?
On a relative basis, it's very strong.
Relative basis to any other country.
Exactly.
Okay.
Relative to Japan or relative to Europe,
Right.
I think it's very strong. One of the reasons why it's so strong is that you've had tremendous value creation in California, in the US in general, with technology companies, whether with software in the 80s and 90s or now with the internet-related companies. And that wealth allows the US government to tax.
Right.
And that's why the credit of the US is well supported by asset values and wealth creation. In Europe, you have not had that same phenomenon. And so you may have substantial amounts of debt, but on top of that, they have not been able to grow the economy as much as in the US. So there is more risk there, we believe, than in the US.
So your cash position, when I looked at it last, and of course it's going to change, I'm looking pretty much at the IBA Worldwide Fund.
Yep.
Is what, around 30%? Is that right?
Yeah, it's come down a little bit.
Right.
And we've added to gold.
All right.
Instead.
So tell me about how you view cash, because you said something interesting to me on the phone, where you didn't think it was as effective a hedge as it once was.
Longer term,
right.
We think that the central bankers are very keen on debasing currency. And therefore, gold may be a more appropriate hedge today than cash in the long run. In the short term, cash will work to obviously provide an optionality in terms of dry powder to be able to buy cheaper securities if they ever show up. But over the long term, I'd rather, you know how Buffett says, oh, the perfect portfolio is 90% S&P 500 and 10% cash. And I think I would argue with him that it may be 90% S&P and 10% gold rather than cash.
He would not agree with you yet on that particular point. But so explain to me, so when people look, I was reading the Morningstar report, of course, about the Worldwide Fund. Right. And one of the things that it said is that because you always want to buy securities at a very deep discount, and the reason that the cash levels are so high and that they vary is that you're not finding the kind of values.
Correct.
As many values as you would, and therefore that would explain the higher cash positions.
Yes. You should know that we're trying to manage the Worldwide Fund as a family trust, basically. We don't care about short-term movements versus indices, for instance, but over 3, 5, 10 years, we'd like to compound nicely, and we want to avoid losses as much as possible, impairment of capital as much as possible. And in today's environment where interest rates are so low, that has pushed asset values very substantially. The expansion, at least in the US, has been tremendous and long, very long by historical standards.
The longest.
And yes, and so we are getting concerned that we're getting closer and closer to a recession. And we believe that that risk has gone up substantially over the last 3 months.
And do you have a sense of when a recession? I mean, you're not forecasters, but
right. Given where the data is, my best guess would be 6 months to a year. And you need to get prepared now because markets tend to anticipate.
Right.
And they fall before a recession is even declared. So.
Looking at the U.S., so I was looking again at what your position is in the U.S. market, and it was as far as a percentage of your portfolio?
Yes, 30% of our equity exposure is in the US. 30% of
equity?
Yes, okay. That is correct, yes. And that's low by historical standards. We're finding more value outside the US than we are in the US at this point.
Right.
And so,
So for the last 10 years, since you started the IVA,
Right.
which was, you started it in October of 2008, right?
that is correct.
Yeah.
Yes.
The U.S. has been the place to invest.
Yep.
And especially the U.S. mega caps,
Right.
it turns out.
Driven by technology, yes.
Right. So have you participated in that in the last decade? Or?
We wish we had participated more. But yes, we still
Yeah.
own Google, we own MasterCard.
Apple at one point you owned, I don't know
We,
if you
we,
still do.
we sold puts. It was a weird way to build an entry point into Apple, but yes, we got exposed to Apple at some point. That is
Right.
correct. We own Microsoft at some point. We still own Oracle. So we've been able, as value investors, despite the fact that we're value investors, we've been able to understand the software models,
Right.
and some of the more stable, more mature technology. But software is a fairly straightforward business model to understand, and we've been able to participate over the years.
Right.
Maybe not as much as we would have liked, but hindsight's 2020. Now, outside the US, there are plenty of companies, there are global companies as well, and may, given the composition of their revenues and profitability, you wouldn't be surprised to find them in the S&P 500. But because they're listed in France or other countries, they tend to sell at some discount, and sometimes that's not warranted.
Right.
So Nestle is an example of a.
So
such
what
a,
is an example?
Nestle.
Nestle.
Is
Sure.
an example of such a company we've owned for years and years and years.
Right. But you told me, I think, that Nestle's it is kind of near the end of its run.
So we see today a very sharp contrast between stable, large, non-cyclical companies that are trading at higher and higher multiples.
Because people consider them to be defensive, and they've got great dividends, and they buy back their stock, and all those things.
And interest rates are very low.
And interest rates, all right.
And so all of that has pushed them up, up, and up.
Right.
Meanwhile, you've had cyclicals, and some cyclicals of high quality, such as BMW or Samsung that we own, that have been pushed down, down, and down. And in both cases, Samsung and BMW, they actually sell on a price-to-book basis below where they were selling in 2009.
Wow.
In the case of BMW, for sure. The case of Samsung, similar levels.
All right.
And that shows you the depth of the undervaluation, we believe, of these more cyclical companies. And the contrast with the non-cyclicals, high-quality companies is now not only sharp, but at very extreme levels. And we think that at some point that will snap back.
So as you said earlier, price matters
It does.
a lot.
Yes.
So even though you're talking about a possible recession in the U.S., and certainly things are not any better overseas. If anything, the economies are slowing earlier
Correct.
and faster. Then cyclicals, you would say, that's kind of a...
It's very counterintuitive.
Right.
Yes. Everybody anticipates a recession so much
Right.
that nobody wants to touch the cyclicals
No.
anymore. And there are a few of quality that we think are overly discounted. Now, I think the proper hedge against that is to own some gold, which historically goes up in recessions.
Right. So the gold piece is very interesting to me. And
Yes, we have 10%
Okay.
of the worldwide fund in gold bullion, and we have 13%, in gold bullion in the international fund. The miners.
So is that a pretty high level for
Yes,
you?
that's a
historically?
high level for us historically.
Do you have a
But
cap, psychologically or financially on that, or?
we're probably nearing the cap.
Right.
The reason why we have so much is that we also have more cyclicals than in the past, and I think so.
see.
You need more insurance, basically,
Right.
against a sharper than expected recession or something like that. And we believe that in a recession, central bankers will manipulate interest rates again, and usually when real interest rates go down, gold shoots up. Now, the reason is that gold is money. It's a currency. You and I can go to Iran, Japan, Russia. Gold will be accepted as anywhere to trade against the local currency and then buy shelter, food, whatever you need. And so when real interest rates contract, gold goes up. And we think that the central bankers, again, are bent on debasing currency to offset the load of debt that exists in
Right.
developed economies, and that they will continue to do so. Now, historically, it's not easy to value gold, right?
No, I was going to say,
right.
I'm just trying to think of the
So
it's illiquid, it's expensive to hold.
It's not that expensive to hold.
All right.
I mean, it's for instance, for
The
insurance
ETFs,
companies in Europe or for banks now, they have to pay to park money at the central bank.
Yes, that's true.
Or even
Negative
in
interest
bonds.
rates.
I think the 10-year bond in Swiss francs is -1%.
Right.
So you have to pay a large amount. The point being that the storing of gold is a lot less expensive than the storing of cash or than the negative rates you get on bonds around the world today, except for the US.
So at IVA, how do you view this phenomenon of negative interest rates?
We think it's likely to be creating bubbles somewhere.
Right.
And one is in government debt, one is in corporate debt, and the third is in China, we think. But we don't know what the end game is. I don't think anybody does. We've been very surprised how long Japan has been able to continue on in a situation like this.
And thrive, really.
Yeah,
I mean,
right.
The economy's
Sure.
not collapsing.
Correct.
Right.
And the GDP per capita has gone up substantially in Japan, partly because the population is shrinking now.
Right.
But it's lasted for a long time, and we're not sure when it ends, but we think it's going to be ugly. In the meantime, owning some gold as an offset against your equity position, I think makes a lot of sense given how advanced the cycle is and what gold tends to do in difficult markets. And we think it's, if you were to look at gold to GDP, which is a proxy for gold versus net worth. Net worth is a multiple of GDP. If you look at that, in September of 2011, gold, ever mind mark to market versus GDP, went to 15%, 1.5.
This is of global GDP.
Yes, of global GDP.
The value of gold was 15% of global GDP.
If we were to go back to these levels in a recession, which we believe is likely, in a recession, gold would be over $2,000 an ounce versus about $1,500 today. So that would help offset some of your losses in equities.
This is absolutely fascinating, Chuck. It really is. But let's go back to stocks.
Sure. Yes.
Kind of that's your stock and trade, really.
Yeah.
Where are you finding values in stocks, in the stock market?
We are trying to focus, as we always do, on quality companies.
Right.
And we're trying more and more to find less cyclical companies that are trading at reasonable multiples. And you have a few in the US that are popping up, either because they are misunderstood, misclassified. But one of them, for instance, is LKQ, a company that provides parts to repair shops for auto collisions. And because it's linked to the car market, the stock, trades at 11 times EBIT or so, but it's absolutely not cyclical.
No, because accidents happen and people have to replace car parts.
That's right. And they have, obviously it's a big procurement operation because you can imagine the number of parts you need. Most insurance companies, except State Farm, use LKQ because they provide cheaper parts either out of Taiwan or by salvaging cars and getting spare parts from those cars that have been wrecked. And so you get your parts for less money. You have to get them very quickly because insurance companies don't like to pay for that rental car that you're using while the car is in the repair shop. So they have a dominant market share in the US, very steady business. The number of collisions was slowly going down thanks to technology. It's gone back up because of texting and driving. We hope that obviously that reverses for the sake of humanity, but in the meantime, it's been helping LKQ a little bit. So it's a mature business, but it's a very nice cash cow. I think a Buffett type of business, really. And it's not huge. So is it part of ETFs or not? I'm not sure. But with certain, when I look at LKQ, would I put it in a trust for my kids and forget about it for 10, 15 years? Absolutely. At these prices, yes, I would.
But you also own Berkshire, obviously.
Yes.
We've talked about that on the show before.
Yes.
But your view of Berkshire, and again, on another program, I had talked about the fact after one of the annual meetings that basically both, I guess Charlie Munger said, that it's not, we're not going to really be able to outperform the S&P, or we might be able to outperform it a little bit better. So it's kind of like an index fund is the way that he was kind of downplaying it.
Correct, absolutely.
And what is your view of
my
Berkshire?
view is probably that assessment is probably accurate.
Right.
But when I look at two things. One, where are we in the cycle? do I want to own levered companies in this point of the cycle? And the answer is no.
No.
So they have 120 billion in cash. They have the insurance business that is not, it's not the same cycle as the economic cycle. And then yes, they are exposed through manufacturing companies to the cycle. But by and large, within the S&P 500, this is, in my opinion, an extremely defensive company. One. Second, we see a discount to intrinsic to the order of 20-25%, which for a company of that magnitude, that large, is actually higher than what we see in other listed companies in the S&P 500 in general. So there is a nice discount. We know they are unlikely to make a major mistake in capital allocation. The last point is, if we do get into a bear market at some point, it's one of these rare companies where the intrinsic value can actually grow because they can put the money to work into equities that may be discounted, buy a few businesses that may be on the block for a cheap price. Last time he bought Burlington Northern, which has been a home run for Berkshire Hathaway. So you have a sort of that option, you know, that I really like of Berkshire being able to grow its intrinsic because of a recession, and that's very unique. And so given where we are in the cycle, I think it makes a ton of sense. And so I would argue over the next 5 years, they are likely to outperform the S&P 500. Because I think the odds of a recession within the next 5 years are quite high.
And as far as technology is concerned, so what are you seeing any values that are intriguing to you in the technology sector that have wealth-creating potential?
We own Oracle, for instance, and it's a sizable position for us, and we think it's one of those companies that is non-cyclical. You know, so much of it is recurring fees on established systems that you really can't rip off. And when I look at the multiples of an Oracle versus the multiples of a Nestlé, Oracle appears to be much cheaper.
Oh, that's interesting.
You know, Oracle, you're paying maybe about 13 times EBIT, and Nestlé is about 22 times today. And so that's one example of a company that we believe is just very mildly cyclical, and that may not have been recognized as such by the market.
You know, we ask every guest for one investment for a long-term diversified portfolio, and you mentioned one already that you would put your kids, into your kids' portfolio. But is there one that we should all own in a long-term diversified portfolio?
I think at this point in the cycle, and for the long-term, Berkshire is the obvious answer at this point. Having 5 to 10% in gold as a percentage of your equities also is necessary, I believe, at this point.
As a value investor, when you look at, we've had this record long economic recovery, we've had a record long bull market, and most investors in the U.S. are invested in U.S. stocks, and they've done quite well because of that.
Correct.
But how risky do you think the U.S. market is now? This is for American investors.
I think part of the answer is a political answer. Part of the last leg of the bull market in the US was driven by lower taxes for corporates. And we have a large budget deficit today, despite having very, very low unemployment. And so how markets and the treasury market reacts to very substantial budget deficits in a downturn remains to be seen. And I think there is a large amount of risk there. It may be that the Fed decides to just print dollars or buy treasuries, and that would just devalue the dollar. If the dollar devalues substantially, usually global markets or international markets do better relative to the US. That's usually when the dollar is very weak. And in a recession, usually the dollar is weak because interest rates get lowered. So I think there is a risk there that people tend to forget about because interest rates on treasuries are so low. We don't know what is too much in terms of budget deficit. So there is a question mark there.
Chuck de Lardemelle, thank you so much for joining us on
Thank you, Consuelo. I really appreciate it. Thank you. Thanks.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is one we have recommended before, but there is even more compelling evidence to support the case for owning gold. This week's action point is own some gold as a hedge against market, economic, and currency declines. Gold has protected investors during every bear market but one over the last 50 years. And that was in the early 1980s when the Federal Reserve was raising interest rates dramatically and successfully to fight inflation. Otherwise, anytime markets were in a bear market, gold prices were rising. World economies are slowing, central banks are stimulating, pushing interest rates and thus their currencies even lower, and corporate and government debt is at record levels. What will hold its store of value and is recognized and traded around the world? Gold. De Lardemelle is holding more than 10% of his portfolios in gold bullion. Most individuals don't own any. This is a good time to consider it. Next week, the case for small company value stocks with small cap pioneer Chuck Royce, why they deserve your attention now. This week in our extra feature, Chuck de Lardemelle explains the importance of being able to change your mind as an investor. He'll share some examples on our website, wealthtrack.com. We want to thank you for your feedback and hope you will reach out to us on Facebook and Twitter and check out our YouTube channel. Thanks for watching. Have a great weekend and make the week ahead a profitable and a productive one.
Funding provided by Morgan Le Fay Dreams Foundation, Clearbridge Investments, a Legg Mason company, Miller Value Funds, Royce and Associates, Matthews Asia, First Eagle Investment Management, Strategas Asset Management, and Eaton Vance.